just mention that, RBI has RBI has injected liquidity, cut interest rates, yields have fallen to less than 6%. We've seen investments, private equity investments have dropped. Now, I want to quickly move on to asking, how returns have varied across this modes of capital in the debt and equity side in the real estate sector, and how developers are leaning to which mode of capital to raise funds. So quickly, if I could just start with Amit, how are you seeing the whole investment eco space, and which are the modes of capital that is preferred right now over the last 4 to 5 months? How was it before COVID? How is it right now? Amit, I think we can't hear you.
Hi, Amit. Can you unmute yourself? I think you are on mute. Or maybe if you can use the headphones, if you have.
Is there a technical issue maybe?
Just select the micro of the audio option where you'll find the headphones. Just select the audio options in the voice control. Just click on the microphone button at the left side, right corner, and select your headphone.
Okay, I think while issues get fixed at Amit's end, could we move to Puneet? Puneet, if you could point out, and firstly unmute yourself, yes, thanks. How do you see the whole access to capital, on the debt and equity side? How has it been pre-COVID and post-COVID?
So, first of all, good morning, everyone, and let me thank VCCircle for giving this opportunity. And it's good to be amongst friends. Both the co-panelists are friends for a long period of time. Coming to a pre-COVID to a post-COVID scenario, I think we need to really look at the sector in a totality. And if you actually divide into various asset classes, largely on the residential side, I think we were already into a certain issues related to a debt side, and the equity was non-existent. I mean, as of 2019, when you look at the top line number, 92% money has come in equity and only 8% has gone in debt. But when you actually analyze it further, all this equity money has actually gone in the stabilized, core, yield-generating assets. Residential, which is almost 85% of the market, has only received 11% capital. So there's definitely a mismatch in terms of where should capital would have been there or not. One interesting thing till pre-COVID also we were witnessing was that the debt was expected to give equity kind of returns. Which probably doesn't really make sense, but that is what has been happening for a period of time, where it was believed that the nature of the debt could still be in equity in nature because of the kind of practically no equity in the projects per se, but largely the high lane early 20s kind of debt is something which the market has witnessed. I think post-COVID, what is really happening, and is we still are only a couple of months there, but what I think what has happened is two aspects. So there's definitely a trend of the stress funds which have come in and started looking at funding. So case in point, the likes of Swami Fund from SBI side has in fact reduced their rate of interest from 15% with a benefit of 14, and now currently all cases that could be done at 12% IRR. So that is not even a regular coupon. But I think Swami is an exception to the market. Largely the investors would look at stress opportunities because this would be an opportunity to fund in the stress space. So that is one trend I feel would happen. The second trend I feel is that because fairly the party is over for the core yield generating stabilized assets, so we would see attraction of capital in the under construction office also, and there have been some platforms which have been announced towards that side. We will come to the logistics and other sector in a bit, but overall, residential and office, which are two large sectors, this is currently the trend, Beena.
All right. So just moving to Ambar, what are your thoughts in terms of the situation right now on access to capital? How are you viewing the situation?
So, Beena, I think it is going to take time before capital is available for real estate. It is an unprecedented time all of us are facing at one time, and really capital comes in where there is demand, right? Today, in the uncertain environment that we find ourselves in, demand is a challenge and will continue to be a challenge for a while. Before we talk about where the capital is going to come from, or while we talk about the same, we also need to talk about where this capital will be serviced from. Right? Today, servicing of this capital is a challenge. I don't think it is possible for residential developers to find demand or cash flow, could service this capital. Commercial real estate, the existing rentals, most of the assets, in fact, almost leased out, are levered already. For under construction commercial projects, I'm not sure where the capital is going to come from in a hurry, because again, this situation is very, very uncertain at this time. The two schools of thoughts on whether the commercial real estate take-up is going to go up or going to go down, still not clear. So right now, I don't think it is a matter of accessing capital. I think it is a matter of preserving where your projects are.
Right.
And from that perspective, the government has actually given out a good push in terms of giving moratoriums, in terms of revoking the IBC, where, you can't take anybody to an IBC over the next 6 months, extendable by another 6 months and so forth. So right now, because of the uncertainty, once things become a little more clear in terms of where this is sitting, how is it settling? Let's get the health issues sorted out, and then determine the impact. And that is when I think capital will be available, because, servicing the capital today is going to be a challenge.
Sure. So access to capital exists, but servicing it is a little difficult. Amit, could I get your thoughts on the same?
Yeah, hi Beena. Can you hear me now?
Yes, we can. Thanks a lot.
Sorry for the technical glitch. I don't know what went wrong in the last minute. I was enjoying the previous sessions. It was extraordinary. Both Jaideep and Rohan has actually stolen the thunder for a lot of us, and rightfully so. So Beena, in terms of your question, going back to what was earlier and what is now. So I think even while there has been a problem in terms of overall liquidity supply over the last 1.5 years. But however, having said that, we did see a reasonable amount of money being made available through funds, through banks, through NBFCs, and through various other modes, including some investors, internal accruals, etc. What we've also seen that people were willing to go ahead and take capital, launch projects, and willing to have a continuity in their business planning. What we've now seen, however, is a fairly tectonic shift in the entire outlook. And Rohan talked about supply side constraints as being the new issue. So we've always had demand side. We have always had demand side issues. We've had liquidity issues, but what this pandemic has done is actually created supply side issues. What that really means for capital providers as well as for capital seekers is they're unwilling to also sign on the dotted line. They're unwilling to underwrite a business plan. They're unwilling to actually take any liability or give any assurances, either in terms of sales or in terms of actual supply completion dates, and any of these other assumptions that would be very normal or very standard for anybody to give in a heartbeat. So I think therefore the deal volumes have slowed down, not just because of the fact that they may be lower capital, but because people are also a little wary about accepting capital. The other thing that has happened is that I think people have conceded to the fact that it's not about the cost of capital, but it's about the availability. So despite the reverse repo rate cuts, despite a lot of the liquidity and TLTRO measures undertaken with the RBI, there's not necessarily been a transmission of these rates to the real estate sector for a multitude of reasons. Now, despite the fact that the capital may not have really become very, very, very cheap, I've seen a lot of conversations in the last couple of months where people have actually started looking more and more at equity-linked structures, profit-linked structures, and a lot of people, including those who are willing to provide the capital, also willing to go down that path. Right. Saying, okay, yes, I'm willing to consider more time. I'm willing to consider the fact that I may not get a fixed coupon or a fixed clip rate on my money over the next couple of years, but I would be happy to participate in your profits. And so there's a lot more rationality, I think, in terms of conversation and being willing to share that upside, which was earlier a no-no. That this is your share of the returns and this is the rest of the profits are mine. It's a non-negotiable situation. So I think that certainly has moved. We saw a few of the equity-like transactions happen even pre-COVID, where a Mumbai-based developer tied up with a Japanese fund and took 300 crore rupees. We've also seen Korean investors come in for the first time and provide significant capital, including at platform levels. We've always had Singaporean, Canadian, and other investors who actually done platform deals. So I think there is certainly a mood for people to look at India as a new destination and looking at the opportunity that may lie within India. Whether that money is going to rush in immediately, obviously not, because of the current lockdown, the current situation, and the fact that we still don't have a handle on how our businesses can actually resume to normalcy, given that we're not flattening the curve fast enough. So I think notwithstanding that, there is a slush of capital in the global markets, and there clearly is a need to realign some of that to emerging economies which are likely to sustain the onslaught, which are likely to show positive growth. I think there are also indicators that we may actually bounce back in terms of GDP growth next year, and it may not look as bad as people are estimating it to be. We've seen services resume. So on the back of all of that, I think there is clearly an indication. We've seen, very recently last week, some of our investee companies or potential investee companies also having conversations with equity partners and as well as global funds on actually taking on new capital. So clearly the mood has shifted to more equity-linked structures rather than underwriting a debt. The mood is also to conserve the amount of capital and resources available in the company and not sort of take on more leverage or take on more capital burden within the balance sheet or be able to service it, and therefore more collaborative environments. Third, also see where is it that one can actually find resources, whether capital, land, construction material, labor, and create a sort of a interlinked ecosystem within the supply chain rather than actually be self-sufficient or self-dependent. So people are borrowing equipment, labor, technologies, people, and a lot of other resources from friends or within the industry to supplement that need for capital as well.
Correct. So as an investor, how do you really see, where is the investor appetite when it comes to, fundraising and investments? Which asset class looks more promising in the whole current scenario? And as an investor, what do you look for when you, plan to raise funds or invest?
So, Beena, squarely for us, first of all, I still believe that mid-income and affordable housing story is robust and will continue to be robust in the foreseeable future, despite the hiccups that it may have faced. Sure. We're not necessarily very focused on commercial or warehousing or data centers or any of the other new asset classes, clearly because some of the new asset classes have untested track records in history. Mm-hmm. Second is that we're not entirely sure the way the commercial space is going to go. We've seen there could be challenges which may be erupting in the LRD space. There could be challenges with the total amount of rentals. The cap rates may actually go up, or the demands for yield may go up. Rentals may fall, therefore capital values may also fall. So we do see some amount of flux in the commercial side, and therefore it's hard to take a call. The easiest piece of the business has been the late stage, last mile or distress financing, where we know that there are enough and more opportunities. And now so, because, I'm inundated, Beena, with opportunities which otherwise we were not seeing pre-COVID, because people are like, hey, you know what, my business was great till February. I don't know what happened.
Right.
My cash flow stopped, customers couldn't come in, housing finance disbursement stopped, labor is asking for more money, materials are looking more expensive. I don't think I can rely on internal accruals on my existing facilities anymore. I will need to shore up cash, finish these projects, monetize my assets, and get out at the soonest. That opportunity has walked in a very, very big way into our doors. So we have raised a new capital through our new fund, and that's the opportunity that we're squarely going after because there is tremendous opportunity. I mean, mortgage rates have been at its historic low. Disbursements have started again from housing finance companies. People do have the option of taking moratoriums on their existing loans. So I clearly believe that that's a space that we really like. We're allocating that capital to that space. And there are players who otherwise would not have come to us, who have otherwise either not taken money or taken very cheap bank capital, or willing to take this capital because they know that the time of opportunity cost is going to be much larger if they don't go ahead and finish it.
Okay, can I ask the same to Puneet? Puneet, how do you see this investor appetite? Which asset class do you see in the real estate that you would be interested in investing?
Sure. So see, at ICICI Venture, at group level, we are actually into 4 businesses, and I will come to real estate question shortly.
Right.
So currently managing almost $2 billion of capital, and both mix of a domestic as well as international capital, right, from infrastructure to special situations to private equity, which has been our traditional business and the real estate.
Right.
Now, from our perspective, see the investors' appetite both on the global and on this thing. If on a current basis, see, it is difficult to price a risk currently. But the 2 asset classes which from our focus perspective, one is continues to be affordable housing. So we have affordable housing fund. So that I resonate with Amit. That is an asset class in the whatever residential is happening or situation is happening. The only sales, because eventually you have to sell to kind of get your returns back, right? So that continues to be our focus, and we would be there. Right. Second, on the office side, we do believe that while we may not hit the numbers of what we had in 2019, the highest ever absorption in our country, but basically I think there's a need to go to office while the work from home is there, the business slowdown and all. But I think in the medium term, this is an asset class from ICICI Venture perspective. We do believe will continue to have an interest, both from the investor as well as from the domestic one. I think the nature of the sizes of those projects may change. So currently, if the investor appetite has been to do in a 2 million or a 3 million square feet of developments, those would move to a smaller, more city-centric, more suburb-oriented projects, because there's still a dearth of grade A office, CBD-centric or a midtown-centric kind of projects continues to be a challenge. Right. Last mile funding again would be of interest to us, and we would continue to be in that space. Because there's a limit to which what a government fund could do, and there's a decent demand both from the market perspective, and there would be a definite interest on the investor side also to come in and do it. There may be a mix of a debt and equity oriented structures, so there could be a debt kind of a coupon with the equity upside, which would come in terms of structures. But basically, these are the focus from our perspective.
Ambar, I'd like to come to you. The last time we spoke, you didn't sound too optimistic about the whole scenario, at least in the near term. Can you let me know your thoughts? Which asset class looks more promising from your perspective? And also a view how domestic and international investors are looking at it.
Sure. So I think I'm of a different opinion compared to both Puneet and Amit. I don't think, first of all, the next residential is going to, give you any opportunity. Okay, this is a scenario where, every single business has been impacted, and I'm not talking about real estate. I'm talking about the economy right now, where every single economist is predicting or projecting a 5% minimum contraction in the economic growth rate in India. We've faced with a situation where people are losing their jobs. People who are going to be left holding on to a job will be working at a far, far reduced salary. Buying a house is not at the top of the mind recall at this point in time for anybody. So residential for the next 12 months is likely to be a big, big challenge.
Yeah.
if you look at the instruments, I think debt, the high yield debt, which used to be the characteristic of residential real estate sector, is dead.
Right.
We started doing high yield residential debt way back in 2012, 2013. There was a time when residential developers used to make a very high margin. Colloquially, everybody used to say that, look, if the developer is making a 30-40% margin, then I can certainly take a slice out of that for the capital that I'm providing them at this point in time, and so on and so forth, right? So residential debt, I think, is dead. The businesses do not have any kind of margins and so forth.
Okay.
With this situation, given what was happening even pre-COVID, Beena, where we were in a huge amount of slowdown. If you look at the numbers, for instance, 10 years ago, India used to sell 500,000 apartments, thereabouts. Last year, we sold less than half that number. Okay. This is going to lead to a huge amount of consolidation. Players with robust balance sheets would play in this space from here on. People like Godrej, Tata's, Oberoi's of the world, and so forth,
Right.
DLFs. Right? These are not the kind of guys who would take high-yielding debt from the likes of us. Okay, balance sheets are stronger, their brand names are stronger, they know how to operate in financial services markets, and so on and so forth. So the era of the real estate high-yielding debt is gone.
Okay.
Even from an equity perspective, while Puneet and Amit both talk about affordable housing and mid-income housing and so forth, I look at credit-linked savings scheme, for instance, right? That's a good indicator of how the affordable housing is doing. And you know what? 2017, 18, and 19, the 3 years that scheme was there, all 3 years put together, only 3.3 lakh houses were sold,
All right.
which availed of CLSS.
Okay.
Right? Compare that to anywhere else in the world. I mean, UK, a small island, with population probably less than a tenth of ours, sells 400,000 apartments per annum.
But Indian developers are claiming to sell a lot even during the lockdown. So do you have a different view on that? Because the sales are happening is what they're saying.
So let's define a lot. Let's define how well we're doing. Yes, compared to previous quarter, you would have sold a little bit more, but 230,000 apartments become 240,000 apartments.
Right.
Given what was happening 10 years ago. See, please understand, real estate industry started becoming organized and in the shape and form of the industry in the year 2006.
Sure.
Back when 2005 was the time when the government opened up FDI, right? And a whole bunch of us got into real estate industry thinking that this has the future given what's happened all over the world, right? So yes, someone would have sold 10,000 square foot, 20,000 square foot, 30,000 square foot during the lockdown, because people pre-COVID have visited sites, have done their recce and so on and so forth, and they took a decision at that point in time. But if in the year 2020 calendar year, if you're going to sell 100,000 apartments, is that doing well? Is that a lot? Is there scope for the likes of us to invest in a market where the demand has fallen by 75% in the last 10 years? I'm not too sure.
Okay.
I'm not so sure. And by the way, in the same breath, most of the pundits actually go out and say that, look, the likes of Godrej and Tata's and Oberoi's and DLFs, these are guys who are selling. But, these are not the guys who pay 20% IRR on debt.
Okay, I can see Puneet smiling. I think Puneet has a view on this. So Puneet, could you tell us as to, how different do you view? And also just to add, do your IRR expectations and multiples change, in the current scenario?
See, I always smile when Ambar talks because he's a friend for 20 years now, right? So, and for that matter, every friend, there. But coming back to this, I think I give opportunities, and the opportunities may vary. So I fully resonate with the challenges in the residential sector when Ambar talks about 260,000 apartments being sold there, and they were about 80% from their peak levels. But does the India still continues to need the homes? I think the answer to that is yes. The fact of the life is that we are all taking this VC or India's your summit sitting from homes, right? So I think fundamentally the demand for homes is not going anywhere. The sector, see, if you look at while we talk about the journey from 2005, Presno to 2005, coming in, and then, the FDI coming in. But in spite of that, if you look at the number of residential real estate developers in the country, I mean, every, in a small micro market, there are about 100 developers. Right. So the numbers are, and therefore, yes, you talk about the pain in the sector, and therefore it is, yes, there is a pain in the sector, because finally the customer has to have a confidence, which means first he has to have a confidence on the job, and then he has to have a confidence on the home. But I have a feeling that in this point of time, this point of time, when I say it is not really a short term, because in the short term, it is a survival. But I think the moment he's come out of that survival instinct, there would be a definite tendency to get into at least a roof above the head, because at least we have seen in terms of various discussions, the way even the tenants and the owners have been behaved or have been dealt with within societies have been very different. Right. So, I'm a fundamental optimist, so I continue to be optimist on that mid-segment housing. The question is, would you get a 20% debt return? I think I said that earlier, that see, we were the first ones to actually start doing this structured debt way back in 2006, right? We were in mid-teens as Wells Fargo. We were the first private equity house in the country to start doing structured debt at that point of time. The mid-teens became early 20s. So I fully agree that the returns on a pure debt model may not work on these numbers, what Ambar said, and therefore there could be a upswing of a hybrid structure with a debt and an equity kicker kind of structure, certain low coupon, certain high-end coupon, but there is a definite need to complete these projects. So the projects are half built, 70% built, or whatever that is, and there's a definite requirement to complete those units there. There's a demand at always a certain price point. Yeah. In this point of time, if you try to analyze demand and say, okay, 1 crore apartment being sold at 90 lakhs, would I buy it? Maybe not. 50 lakhs, would it sold at 45 lakhs, 10% reduction, would you buy it? Maybe not. You will postpone that decision. But I think at some point of time, the fundamental demand is definitely there. And at some point of time, I feel is a midterm situation.
Right. So quickly, if you could say, how much will the returns change for investors like you and for the industry?
See, we're not necessarily guided by a number, Beena. I know you kind of asked that question to me earlier. So it is not necessarily the number. It is purely opportunity driven. So whether you are getting into a last mile funding, it is a risk related to a return, right? And what stage of the project you are getting into also determines the return. So, that really would be my answer. So it is a very, very opportunity driven in terms of returns.
Amit, I think you would have a view, how will IRRs change in this scenario? It's been unprecedented.
So, Beena, to be very fair, I think the risk perception has gone up, and there are two ways to handle this risk perception. And I think rightfully so. And I think Ambar has been very vocal about the risk involved, about the uncertainty in consumption, about basic economic issues, including job securities and cash flows at the enterprise level. Now, notwithstanding that, right, to the extent that there are buyers available, I think there will be time to conversion. There are supply side constraints. You mentioned that. It will take longer to deliver. People will therefore need to come in more cautiously into buying these apartments. I don't think we have any doubt about that. So for that added risk, for that added uncertainty, while the outcome, I think, is still certain, the timing of that, the returns or the margins that may be available at the end of the day, and therefore the issues that may disrupt, lockdown, lock on, lock off, whatever may happen, Beena, with us, we need to factor those into our business plan. So I think in general, there is a need to provide better returns to investors. Right. There's no doubt. There is no need for people to put capital otherwise. So we are actually looking at almost 200 to 300 basis points of returns higher than what we would have actually done pre-COVID. Okay, granted that maybe for fantastic players, absolutely, with ratings which are investment grade players, then they obviously the delta may not be that high. Sure. But for anybody who's not necessarily a grade A player, barring those 15, 20, 25, 30 players in the country that were starting to deal with still, I think there will be a delta. And it could be as high as 200 to 300 bips. And that's really the requirement. The second clearly is the fact that there needs to be a higher margin of safety, something which Rohan also alluded to. So all our transactions, all the ICs that we've had now recently have singularly said, I think we'll need more time. The projects will need more time. Let's buffer in a higher margin of safety. and let's see how much more money we can make at the end of that term. So I think both these are important. A, creating a higher risk mitigation structure. B, looking for optimizing returns. Because remember that there are multitude of investment opportunities that today the investor is going to have, whether it's in the distressed asset side, whether it's including buying distressed bonds or distressed capital market issues. There are lots of opportunities which are coming up, not only in India, but world over. So as fund managers, as investors today, it's important that we're able to create.
Amit, you'd been muted. Unmute.
So clearly, that's really where we're going to be now. I think the returns will be looking in the early 20s or late teens, early 20s for us for sure now.
Sure. So quickly, because we are running short of time, I'll just want to add one last question. You mentioned about stressed investments. Going forward, will we see more stress deals given the scenario? And, as your own as an investor, how do you look at it? Will you invest more? Something more concrete as to what will be the investments in that space.
So there are two types of stressed assets, Beena. One is where there will not necessarily be a haircut, but a lot of the institutions, a lot of the banking folks are willing to be subordinated. Something which wasn't happening so much till early last year. I think we see that as a fantastic opportunity. We're aggressively pursuing a pipeline where there is so much value already which has been accretive into the project because of the capital that already has gone in. But there were disruptions in the entire business plan. People thought too big, people thought too much, people thought they'll be able to do faster than what they've done. Clearly, it hasn't panned out. So by putting in a small sliver of capital, we're actually sitting on a very large capital stack. That's effectively a distressed opportunity for us. But fundamentally, there is still reasonable margins, at least for our money to make.
Any quantum you'll be looking at?
No, so I mean, I think today we're looking at least $100 million to basically go after these opportunities. The total amount of capital deployed, was very, very large. With almost about $20 billion, in through banking NBFC space, which is going to structured credit. So we're looking at a very, very small piece within that space. So clearly, that's a distressed opportunity for us. Second, we're also seeing now, of course, now IBC has stopped, right? And we may not, see new IBC cases. And that was one of the ways where people were looking to actually go into and maybe acquire those assets. But for those which are existing, and given the fact that things are going slow, I think there is a sense of desperation that is seeping into the credit committee members, into people who are actually stuck. And we're hoping for a resolution sooner than later, saying, okay, guys, can you come in and can you get this done? So while, of course, there's the SBI Swami Fund and there are other, potential players in that space. But for people who are necessarily not wanting to go the NCLT route, people who don't want to stay stuck in the NCLT, they're coming us and asking us to effectively see if we can, put in the capital, bring in a third party player and have that work. That's something we're excited to.
Sure. Okay. Ambar, your thoughts on that? Stressed space at least would be looking interesting.
Okay. So developer side stress has vanished.
Okay.
There's no stress anymore.
Okay.
Nobody can take them to IBC anymore.
Okay.
The government has given out a moratorium. RBI has given out a moratorium to all the developers of the next 6 months. Okay. So the stress is gone. There is no stress. Nobody is willing to talk anymore. What Amit alluded to is exactly what will happen and will continue to happen, where a lot of NBFCs are stressed. I don't think banks are stressed anymore either, because of a variety of things that the RBI has done. The repo rates are at an all-time low. The cost of capital is so low, whereas my home loan is still at 8.5%. Right, so they're making enough margins out there. Banks are not stressed. NBFCs are stressed because they're getting, sort of force from both the sides. On the one end, the borrower says that I've given you a moratorium, and on the other end, the bank says I'm not going to give you a moratorium. Right. Okay, so a lot of dislocation on that end will force NBFCs to do distressed deals, but that is secondary. Beena, my problem over the last few years in real estate has been exactly this. Okay. So while on the face of it, when Jaideep presents a whole lot of numbers on private equity capital that has come into real estate, bulk of that capital has gone into lower risk completed assets. Okay, the capital has not gone into under construction or development oriented assets. Right? It's the same problem that we're facing today. That problem has not gone away.
Right.
The developer stress is just not there. My developer today, my borrower developer, or the one that was going to sell me a completed asset, pre-COVID, is now saying that, look, it is status quo. We are not talking about anything for the next 12 months. Next 12 months, I don't have to do anything. Today, I have a choice to do nothing.
Okay.
Right? Because this pandemic is a godsend
Sure.
to almost 90% of the developers out there.
Okay.
So distress on the developer end is completely gone. Right. Which might not be a bad thing. I mean, it may impact, some businesses like mine and Amit's and Puneet's, but on an overall basis, I think for the country is a good thing. For the industry, it's a good thing. But distress, I don't think is for the next 12 months, it's gone. And after 12 months, in any case, most of the guys are going to die, and there will be a lot of consolidation and so on and so forth. So yeah, it is. These are dark times, guys.
You're being too grey about it. I don't think it's that grey and dark, my friend. It just looks dull. If you get out of the house and you move around, you'll see that the world is still existing around us.
How do you the fact that distress is there?
I think we have one last question from viewer. As a bullish investor, this is to Amit. As a bullish investor on residential, what is your view on inventory overhang and its impact on returns? And is there enough market confidence in supply over the next 2 to 3 years?
So, Beena, yes, there is an inventory overhang. It has been there and will continue to be there. Having said that, and it will take time for that inventory overhang to liquidate itself. I think there is no secret there. I think enough studies, enough numbers have been put, whether it's 1 lakh crores or how many number of units in every city, numbers are very well available. So clearly that exists. Now, when you look at that in a more granular way, it could be a mispriced product, it could be a misconstructed product, it could be a product in a bad location, it could be a non-sellable product as well, or it could be a large ticket product which is really not selling. So there could be certain sort of issues with regard to that inventory itself.
Right.
Having said that, we've seen that those who had decent product. I was just talking to one of the developers yesterday. He said, if I could reduce, they went ahead in a tier 2, tier 3 market, reduced price last year by 5 to 6%, put the entire stock on bid and liquidated and cleared that inventory. So people did have the opportunity, if they were being rational enough, to sell what was saleable by doing whatever the market needed. Now, clearly, that market also does not exist. So there will be a pain on that side. There will be delinquencies. There will be write-offs. People will end up holding inventory. And of course, a lot of representations have been made by the industry that let's allow FDI into ready inventory. Maybe they can convert that into co-living or into some other rental asset class and maybe monetize it like that over a period of time. So that's a persisting problem. So one can't obviously sort of get stuck with the legacy issues of that inventory. What is relevant today is clearly what is required today. And let me also say that the parameters pre-COVID and post-COVID in the development space has also changed. The need for space, the need for wellness, health and safety factors, the design aspirations, a lot of the things have actually changed. And people are willing to pay more for it if they're still in the buyer market. So clearly, I think, we're looking at it also from that perspective that, notwithstanding the inventory, yes, if there's an inventory overhang in general in a micro market, that's not the market you want to be in. Clearly, you have to be in a micro market that works, that moves, has the right products, has the right people, and will continue to move. Bangalore has a ton of them. Pune has a few of them. Mumbai has got a few spots of them as well. So clearly, I think it is about choosing the right opportunity. And there are opportunities. And in fact, there are better opportunities today than there ever were because people are willing to consider these factors. They're willing to consider that, yes, there are elements of risk and they will need to reconfigure their spaces. They will need to reconfigure their entire approach to development. And they're willing to sort of have a more collaborative approach to development and investment. So I think we're fairly excited about the fact that today we have a more collaborative environment. We're not just capital providers and they're not just capital seekers. I think it's a more cohesive environment that we're looking to get into going forward.
Great. On that note, I think I'll have to wind up because I'm being asked to wrap up the panel. Thanks a lot for your views.
Thank you so
much. But thank you so much for your views.
Thank you.
Thank you so much, Beena.
Thanks a lot. Thanks, guys.
Thank you, Beena.